Good morning. Welcome back to Hurdle Rate. I hope you've all had a wonderful Christmas. And for today's video, we're going to build a DCF model from scratch for Duolingo. As you can see on the right here on the graph, the company since its IPO has been on, I guess, quite a wild ride. It had this huge surge up to over $500 from dollars. And then it's recently, over the last, throughout this year, has crashed back down to 180. So let's try and find out what the intrinsic value is for this company based on our assumptions. And let's see. So first things first, go onto the SEC website, search for Duolingo, open up the most recent 10Q, and then on the second page, about halfway down, you want to open up the 10K here. And go to the 10K, come to page 101, and this will give the disaggregation of revenues. And for the same thing on page 17 for the 10Q, and then we can move on to our Excel spreadsheet. Open up a fresh sheet, go to page layout, remove your grid lines, go view, freeze your first column, insert another column, make your A smaller, make your B column larger, and I'll zoom in a bit for you all. In cell A1, type DUOL. Now that's the ticker symbol for Duolingo. We want to go data, select stocks, be on the NYSE. Yeah, there we have it. It's automatically done it. It didn't require me to select it. Reason. Go ticker. We want the date. We want to know if current price, the implied price, and then if there's any up or downside to the company. As always, we're going to do a quick bit of formatting. The first section that we're going to build are the assumptions. And these will be, one second. And these will be our revenue segment. And we're going to split the revenues into what we see here. We have subscription. We're not going to use this other one. We're going to use advertising, Duolingo English test, and that will be our revenue breakdown. So revenue segment, which is, and these will all make sense as we build them out. This just allows us to simulate between different scenarios. Then advertising, Duolingo English test. In-app purchases, other. When we're building these out, initially it's always a lot of formatting to begin with, but then we start building out the content of it. So the next three items, your EBIT is your earnings before interest and tax. It's your operating income. Then we have the WACC, the weighted average cost of capital, then the terminal growth value. And I will explain those as we get closer to them. Right now, we just need to focus on the revenue. In the switches, leave them all to 2, but leave this one blank. We won't need to do anything with that yet. Functions. Now revenue build. We have quite a few, so we have, what is it? We have 5 revenue segments. So let's start going. We're going to begin in 2022. Need to get to L. Okay. Zoom in a bit more for you. Okay, looks good. Okay. So the first revenue segment is the subscription. We want to format the numbers. So there's no decimal places. We use the comma to separate the thousands, and we put negative numbers in brackets. Below that, we want the growth rate. Then a way to flick between our different scenarios. So subscription revenues in 2022 started at 273,507, and these are in thousands. So we need to remember that. In other builds we've done for much larger companies, it's been in millions. So let's put that there. I wonder, do we equals A1. Right, the date today is the 30th of the 12th, 2025. We'll leave it as thousands. We won't change it into millions. No, actually, we will. Let's change it into millions. We put a point between where the comma is. We put a decimal place. So in 2024, they finished the revenue at 608 million. The first 9 months they did 433. So let's work out what the multiplier is. 433.214. Okay, so equals 631.156 multiplied by 1.402380. And that's to work out the growth rate, you just take the year that you're looking at, divide it by the previous year, and subtract 1 and convert it into a percentage. Format it into a percentage. Now we want to start forecasting for the next few years. How we do this is we can say, okay, let's just take an average first. 48%. Put this to 2 decimal places because it's easier to and it probably in 2030, let's say it goes to 20 equals G10. And I think a bear case for this could be 90% of that, 90% of this 20%. And the bull case would be, I think, 105%. To work out what these cells should be, so it's at 48% now and it's trending towards 20. We go equals the previous year minus, open brackets, the previous year minus the final year divided by the final year, as in 2030, minus the previous year. And we're going to use this again, just copy paste it, so we need it to update dynamically. Therefore, what we need to do is we need to lock in a couple of things. This doesn't need to be locked in, this doesn't. This one does, because this column will always be the same, but the row will be different. This one will always be the same, so we lock both of those in. Then for this one, the row will always be the same, but the column will be different. So we lock in the row. Like that. And then for the bear case, we take the base and we multiply it by the bear. And remember to log that in because we're just going to pull it along. We do exactly the same for the bull case. The reason we're saying is that maybe going with a 20% base is probably actually at the upper end of what the base can be. So the bull upside is probably significantly less than what the downside could be on the bear case scenario. So to switch between these, to simulate the different scenarios, we use something called the offset function. And for that, all we do is we go equals offset, then we select the cell that we're in this case it's G26, the switch, which is this one, but we need to lock this in. Then another comma, then 0, close brackets. It's formatted the same as into the percentage, and then there we have it. So to forecast these future revenues, we just take the previous year, we multiply it by 1 plus the growth rate. Yeah, there we have it. Pull it along. So I think this is a bit too much. From my reading, total revenue will be about 2.5 billion. So let's change this to 10%. Still too much. I think it can still be 10, but we're going to say this will be 30% because to have 3 years of nearly 50% growth is quite a bit. So 2 billion in revenue for subscription by 2030, with the rest of the revenue 400 million in all of these, I think is probably quite fair. So let's go with that. Then, okay, so that one's done. The next is actually, let's just copy, paste this. Equals B11. So come back to your 10K. Advertising is 44.731, 49.858, 54.907 for 2025. So if it ended on 55 and it had done 40 billion by this by the first 9 months of the year, we get a multiplier of 1.35. So we say 59.504 multiplied by 1.351, 8897. It's quite a chunk. With this one, we will use the average from the last 3 years. Is that right? 25. Yeah, okay. So we'll put this growth rate to eventually, I think, settle at 5% per year. Because ideally, Duolingo probably wants people more on the advertising is probably really only going toward the casual users. It's the subscription that they want to probably drive forward. Ooh, yeah, okay, that looks good. Let's just make sure we're all in the right. This will put us 95%. Same there. 405 was the previous one. For you, change it to 11, or for me, E11. Just doing things up with the right switch. And to show you how the switches work, as you can see, okay, let's just go with subscription. Remember these figures here. We're currently on the base case. We go to 1, it comes down. Go to 2, we come back to base. Go to 3, it goes up. So that's what we're doing with the switch. Okay, now the next. Maybe this only actually goes 3%. I'm picking these figures out of thin air. There's no yeah. Well, do your English. So back 17914 3473 3853. So I guess this is why the stock shut up. I'm saying, wow, it's going to continue having these 100% increases, and then it doesn't. Your English 34.2. Wait, I forgot to put my decimal place. See, this multiplier is significantly less than what we had up here. So what would that be? Equals 31.723 multiplied by 1.1293791. I think we just take the average from the last 2 years and we put it at a 1% growth per year. Okay, let's give it 2%. I'll fix that in a second. It shouldn't be 0. I just need to put a figure in the cell at the top. See, it's working now. There we have it. So it does look like the Duolingo English test segment is, yeah, it's plateauing, and it will probably be like that rather than being a fast growth segment. Okay, so the next one would be 13, in-app purchase. I've done that wrong, sorry. I went on the wrong line. In 2022, 32.718. You have to be careful with this because it's so easy to make mistakes, especially when you're trying to rush through. But the good thing is we can leave this as it is because we did it right the first time. So we did the in-app before we did the Duolingo English test. 46 divided by 4.25. 3 multiplied by 1. 5281. Okay, yeah, so we can leave it at that. Now come on to in-app purchases. Let's see if we. Gosh, I have to make sure I got this right. Sorry, guys. Yeah, it makes sense because it was lower than the same time last. But it was lower than the same time the previous year, so we're good. The in-app purchases. That's right. For this one, we say take equals 39 divided by 2951. Listen, the growth is quite good. It's not terrible. This is probably going to let's call it 6%, 5%. The last segment now. Back to your 10K. So this is 0.625, 0.682, 1.293. Divided by 0.909. 1.410 multiplied by 1. It's the other part is growing. Yeah, okay, we'll leave it at that and we'll say it goes for 1% growth. That one is such a small part of the company that it doesn't really matter if that percent. Okay, looks good. Let's total all of this up and we'll move on to the next section, which will be the income statement. Let's go equals sum. Yeah, I mean, we've got that at about 2.5 billion, which is, I think, what analysts are estimating for the company. I think advertising, let's just increase that to 4%. Yeah, happy with that. Actually, I think we can make this a bit better as well. 12%. There we go. Yeah, I'm happy with that. Income statement is the next line. We go revenue. We just copy what we put it equal to what we've just built. Oh, pull that along. Okay, so come up to the income statement, which is this one on page 6 for the 10Q. For the 10K, it is right here, this one, page 86. And we want the line that we want, this one, income lost from operation. So it's only in the last year, 2024, that the company became profitable. So yeah, let's minus 65.871 minus 13.314. No, sorry, it's minus 65,195. This one up here, 13,259. D2,595. What that is a percentage of revenue. Down here, we'll add the taxes in, which are a wee bit. So they paid 938, 1.710, 13.732. Onto the 10Q. So if we take 63 to the full amount for 2024 divided by 48.713, get 1.28. We multiply 92.116 multiplied by 1.2849753. An average. Pull that along. This is just the placeholder, this EBIT. It's not the one we're actually going to use for the unlevered free cash flow. That will come later on in the model. You'll see as we get to. So they made. It's strange. 14. I think we'll just leave this in. 0.20. They benefited there, but that's not going to be the norm. We'll put a 20% tax rate going. Rules. EBIT multiplied by the tax rate to find out. Okay, that's the income statement done. Let's move on to the cash flow item. They are the depreciation and amortization. Your capex and your change in net working capital. To find these, we go on to the cash flow statement, which is here. We need this line. We sum whatever's in here, and we purchase a property and equipment. Eight seven 4.870, 7.095, and 0.84 as a percentage of revenue. This is this divided by 7.193. Your capex down here, the other one first. So sometimes it can be tempting to put this one in, but then we have to adjust, I think, the R&D spend. So we'll just go with this. It will make things very complicated if we do that, and that's probably for another video of how to capitalize R&D. We'll do that later. I mean, I think a lot of tech companies do that. 5.562, 3.191, 12.116. Pull that along. We take this 12 and we divide it by 7.369 multiplied by 1.1931068. Now the change in net working capital. So simply, we just sum all of these. Remember to put the decimal place in brackets, they're negative numbers. negative 0.048. Oh no. Negative A again. I keep forgetting all of these. Actually, I think I've done a mistake here. We don't need this non-current asset liability. Is it? That's just remove the last one here on each thing. I know it's only small, but let's try and be. There we go. Because it's for the current assets only, the change in networking. So just what to do, we'll just sum what these are here, then we're down on the networking cap. 8.84, 11.74, 813, negative 519. Done. Going forward, we just take an average of the last 3 years. Okay, so yeah, this will negatively impact free cash flow because it's positive. If it was negative, it would probably be a bit better, but we'll cross that bridge when we come to it, when I explain how we function. Unlevered free cash flow. Cash flow items, we want DCF next. Again, revenue, growth. Just put this equal to what we have up here. Pull it along. So now we're going to calculate the EBIT properly. We need to change it so that this is percentage of revenue rather than what we've just rather than percentage growth. So for EBIT, let's say that this eventually goes to 26%, because I think that's what they're forecasting, is that there will be margin expansion as revenue pattern. And it's not looking great for the last few years of EBIT, but it's just they've had to spend so much on research and development. See, look how much they're spending on research. Yeah, yeah, that's a lot spent on research and development. So why that's something wrong there. We haven't. Okay, that's better. I think the EBIT for the no, I think this will go higher next. I think it's the EBIT's increasing, and I hope that should continue. Yeah, that looks good. I'd left it on the revenue for the advertising rather than updated it to EBIT, hence why the bit off. But yeah, that's good. But your taxes equal to what we've calculated before. Obviously, we want the percentage of EBIT. We will say that, let's say, I mean, it's hard to say what the tax rate is going to be because it hasn't consistently paid because of the operating income was negative, and then they obviously got the benefit last year, so they haven't consistently paid tax. So we don't really know what the rate is going to be. But if we say it is, how about we say, so on for the last month, they did 6.6% in income tax in 2024. Let's just say it goes to 20 and they start paying a normal tax rate. We'll keep it as what we said at the top. There we go. Then you multiply your EBIT by the tax rate, and that will give us the amount of tax that they should pay over the next few years. So just on the EBIT, updated, so it's in row 16. Well, row 16 for me, whatever your EBIT column in your assumptions is. This EBIT needs to be equals revenue multiplied. There we go. Okay. For another border, sorry, no, we don't want that. This is the EBR, the earnings before interest but after tax. The way we calculate that, we just take our EBIT and we subtract our tax. There we go. Now bring back in your cash flow items. change this to unlevered free cash flow. And the way we calculate the unlevered free cash flow is you just go equals, you take your EBR, you add back in depreciation and amortization, you subtract your capex, and you subtract the change in net working capital. And there we have it. And it's not that much. I mean, 78,131,282, a company that is valued in the billions. And I guess maybe it's difficult because if you look at the revenues, initially we thought this was going to still be stratospheric growth, but the growth rates we're putting in are that the company's maturing, and that the analyst estimate, the fact that it will do about 2.5 billion in total revenue, is that the stratospheric growth is very much changing into mature. So, so now we have our unlevered free cash flow. We want to find out the present value of unlevered free cash flow. To do this, we need to build a WACC. So that's the weighted average cost of capital. So open up a new sheet. Okay, so a bit of a problem. They don't break down the revenue on the 10Q by regions. That's going to have to use the previous years for 2024 for our equity risk premium, which isn't great, but we'll do that. And then when they release the next 10K, then it can be updated. So yeah, let's build the WACC. So you've opened up your new sheet. Come on your 10K, just come to page 101. And we can see the breakdown here. It's pretty much, I mean, let's say 60-40 for rest of the world to US. It tends to break down for revenue. So I'll zoom in. As always, remove your grid lines, make your A a bit smaller, put your ticker in there. Data. Go. So what is the WACC? The WACC is your weighted average cost of capital, and you calculate it by, the formula is percentage of equity multiplied by your cost of equity plus your percentage of debt multiplied by your cost of debt multiplied by 1 minus your tax rate. So we need the market cap, which we can get, because this helps us find percentage of equity. To do that, we just go equals A1 dot market cap divided by 1,000,000. So Duolingo is an $8 billion has an $8 billion market cap, over $8 billion. We want percentage of equity. We can't do anything with this yet. The cost of equity is next, and that consists of the risk-free rate, the beta, and the equity risk premium. And we want percentage of debt, cost of debt, the tax rate. Sorry, we need another line here. Total and WACC. So we can find out what the debt is. We just go into the most recent balance sheet. And here it is. So the company has 0 debt. We just need to focus on the cost of equity. This is all we need. That we know the risk-free rate. That's the UK one. The US, 4.124%. The beta, we will build that out now. For that, we need to know the industry, the levered beta, revenues, EV to sales, the value, weight, and then weighted beta. So if we look at, let's come back to the revenues for the company, for Duolingo. Where are they? Down here. No, I think they're at the top, sorry. Okay, so subscription. So advertising will be one of the segments. We'll put that in. Then the rest is software. So we'll go. Let me put up my spreadsheet. We're going to say advertising. Let's say advertising. Education. Let's look at education and also software. I think software internet. Okay. So education, software, internet. The unlevered beta for these companies, for these industries are 1.15, 0.78. What was the last one? 1.32. The revenues, we can say for advertising, we would go 59.504, that's clear. Education, would be this Duolingo English test and the subscription. I'd say the subscription is education 631.156 plus 31.723. Then maybe the in-app purchases are software. Four 110. And we come on to the price to sales. Advertising, education, software, internet. I wonder, I mean, do we? Yeah, okay, let's go with that. I was going to say gaming, but no, I don't think we will do that. Okay, so EV to sales. Then we go, the value is of each segment. You know what, let's do the annual revenue, sorry. Equals subscription plus. And this will help with the value. Actually, no, because we know what the 564 weight divided. The beta, we would have it at 0.87. What we've done here is we've taken the revenues for each industry where Duolingo operates in. We've worked out the value for each revenue segment, which is given us here. We work out what the weight of each segment is to the whole company, and then we multiply the weight by the unlevered beta, and we sum all of these up and we get 0.7. And the equity risk premium, so go region, we're going to go US and rest of the world. Or because we're having to go with the previous year, we'll just use the same. Okay, we'll keep it at 46% of total revenue. So region, we want revenues, ERP, weight, weighted ERP. So this, we come over and take the total revenue for 2020, multiply it by 0.46. And this one, we take again, multiply it by 0.54. So we know the ERP for the US is 4.61%. And for the rest of the world, we just take, can't do it on this because it's not linked properly, but we'll just remove North America and we get 6.41% for the rest of the world. So the weight, you go again divided by, I mean, we already know the weight because we decided them. 5.58%. F36. Okay, so our cost of equity equals the risk-free rate plus your beta multiplied by your equity risk premium. So we just go risk-free rate plus the beta multiplied by the equity risk premium. We get a cost of equity of 8.98. So we come back over here. Because there's no debt on the company, we don't need to work out the debt part of it because it's going to be 0. the bare would be we add 0.5%. And the same for the ball, but we just minus 0.5%. The lower the WACC, the less risk. We're going to say the terminal growth value is 3%. For the bull case, we say plus 0.5%. For the bear case, we subtract 0.5%. Now we do exactly the same as we're doing with here with to create a switch, but we use the choose function. We just select all of these in order, put a comma after each one. There we have it. Okay, we're good to calculate the unlevered free cash flow, the present value of free cash flow. Above on the DCF section, put 0.5. Pull all of these along. These are our time periods, and we're using the mid-year convention because we're saying that Duolingo collects its revenue or its cash throughout the year rather than just at the end of the year. So we put the midpoint to smooth that out. So we just go unlevered free cash flow divided by 1 plus the WACC, which we lock in, close brackets, to the power of the year that we're looking at. Pull that along. We follow that by calculating the terminal value, which you take your final year of unlevered free cash flow, multiply it by 1 plus your terminal growth value. Then you divide it by your WACC minus your terminal growth value. Then we want the present value of the terminal growth value, which again, you take the terminal value divided by 1 plus the WACC to the power of the final year. Now we have our forecasted unlevered free cash flow and our present value of terminal value, the present value of the unlevered free cash flow, the present value of the terminal sum. And we add all of these together, get our enterprise value. Then we add back in the cash, subtract the debt. The debt we know is 0. But the cash come up onto the balance sheet. Here we are. So they have about 100, about one and a bit billion in cash. This will give us our equity value now. So let's do this properly, because one day when they take on debt, we will fill in that figure. For the diluted shares outstanding and the implied share price. The diluted shares outstanding come onto the income statement. Must be a separate thing that shows the share count. Okay, there'll be a completely separate section. We want diluted because there will be a lot of stock-based compensation that could potentially have to be exercised if for a company like Duolingo. Okay, so this is what it would be, 487 in thousands. Okay, so 48.766 is the share count. Now we take the equity value and we divide it by 9. We get the implied share price at about 130. Equals K119. So the up and down side. Oh, that's right. So it's maybe a 30% downside. Let's see on the bull case, what do we get? So not too far off on the bear case, about 100. So, okay. So yeah, I mean, this was obviously, again, this is not financial advice. Put your own numbers in and see what you get. We'll see when they release their full year earnings, what we get, and then we can adjust it accordingly, and then we'll get a better understanding of how well the company is doing. But great, that's it for this video, and I'll see you on the next one. I might put it out before the new year, but if not, everybody have a good year, and please have a good new year, and please do subscribe. Thank you. Bye.